It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome, welcome. It's the Jill on Money Show. This is the program that takes the mystery out of your financial life. You know how we do that? We actually use you. Yep, we're using you. I'll admit it. We, Mark Talercio, my executive producer, and I, we are both certified financial planner professionals. We don't do it for a living. We do this for a living, media stuff. We use that CFP to answer your financial questions and have some fun. Again, and like we do this so that we can have a conversation about money that doesn't feel so heavy and it doesn't feel heavy-handed and it's not blaming and it's not shaming. It's just about you and what your needs are. So if you've got a financial question, just go to our website. It's jillonmoney.com. And all you need to do is click the Contact Us button. Once you click that, we'll be happy to bring you on the air if you so agree to that. It would be totally fun. Today, we are starting with listener Jennifer, who's on the air from New Jersey. Hi, Jennifer. How can we help you out?
Hi, good morning, Jill. I'm trying to determine if I need a partner on my journey towards financial independence.
Okay. Tell us more. What's going on?
Well, my husband and I we don't have any kids, so that's a yay. And we are 40, well, and as much as we can save money, or more money, I guess. We are 45 and 43, and we have had someone take care of our money for the last decade, 8 years. And turns out that he wasn't really doing what we thought he was supposed to be doing. I thought.
Wait a second. What did you think he was doing?
Well, I thought he was going to help us make financial decisions, the big stuff, where to put the 401k, where to put the IRAs, where to, insurance. Basically, what I've discovered is what a CFP is supposed to do.
Is he a CFP?
He is not a CFP.
What is he? Is he just a broker?
No, he is a CFS and a CRPC.
Now, I just want to say, gang, that I knew these designations, these letters were thrown out in Jennifer's email, and I had never heard of them, and so I actually had to look them up. So I went on to the finra.org website because these are different designations. And so what a CFS is a certified fund specialist. You either have to have a bachelor's degree or 2,000 hours of financial services work experience. Then you have to complete a self-study program, and there are some exams. I mean, I don't know. I guess it's better than nothing. I never heard of it before, so that seemed weird. The other one is a chartered retirement planning counselor, which is an online instructor-led or self-study course and a final designation exam. These two designations are sort of, I don't want to get a CFP because that's like harder and more onerous. So I'll get these other things, but they're just plain old professional designations. I don't know. I'm not like, it's not a CFP and it's not a CFA. So if you go into, this is just something that you guys should know, is that like when you look at all of these different designations, it's a little bit of an alphabet soup and it's tough to understand what anything means. Generally speaking, the gold standard of financial planning is the Certified Financial Planner designation, and CFA, which is, it's a very difficult exam, I must say. So that is a chartered financial analyst. That's often the people who are fund managers or money managers. They'll have that one. And of course, the CPA, which has its own designation for planning. So if you're a CPA, you can do something called the PFS, which is a personal financial specialist. So those are the biggies, those big three. Okay, now, Jennifer, tell me, what did this person do for you right now?
Well, I don't know if he did anything per se. I mean, he had my money in one of the longest bull markets. So I don't know if he could have. I think if he had thrown money at a stick, it would have made us money.
Definitely.
So I think we were lucky in that the timing was good, and we are very diligent and we are very constant with putting money in, so that's a common thing. So we had the time on our side where we had a really good market and we had the consistency of constantly putting money in.
But what is it invested in?
So that's where it became sticky. At the time it was in, for both of us, my husband's rollover, my rollover, and my brokerage account. I was in 15 funds. My husband was in 17 funds.
What? In each of those accounts?
In each account.
Oh my God. Okay. And are they commission based funds or are they?
They were mostly ETFs and a couple of index funds and a couple of proprietary funds, which we actually did not find out about until we started talking to Charles Schwab's people. And the guy was like, oh yeah, that's a fund that's run by the fund company that basically everyone's money needs to go into that. A certain percentage of your money goes into that anyway. So even if it doesn't serve you, which was sketchy at best and a little bit at worst. So that was, but the thing was, it made money. It just never really kept pace with the market. And that kind of was, and we weren't in and out in any grand scale. It just felt as if it was, the selections weren't. I mean, if he could have put me in the total S&P fund, I probably would have done better because we don't trade anything. So for me, my question is, and actually since I sent you the letter, I've actually since signed with Facet. Well,
oh, interesting. Okay, so let me ask you a question. How much money is in? Each of you has a rollover. So what's in your rollover account?
My rollover, as of today, is just a squeaking pass of $600,000.
Wow. Okay. What about your husband's rollover?
His is just shy of $200,000.
And you're both working currently, right?
Yes.
Okay. And what's in the brokerage account?
My brokerage account has $37,000. And my husband's has, he plays with his. So his doesn't really, he has individual stocks in his.
Oh, boy.
So his has just shy of about 11,000.
Okay. And how much you guys make together?
Well, that's where it gets fun. I make 125, which is not to say only, by the way. That's a lot stuck out. But he just started, so he's starting a new job in about 15 days, but no one's counting, where he got a $50,000 bonus. So his salary is now, a bump in salary. So he's gone from 120 to 172.
Wow, that's great. And so in your current job, you're using a 401k?
Yes.
And how much is in the current 401k?
The current 401k is just shy of 100,000. It actually made a bit of money, and now so she's languishing a bit.
Okay. And your husband hasn't started his new job, so he'll use
He hasn't started his new job. His current 401k, he's still there, is at 180,000.
All right. And he'll roll that over into his rollover?
Yes, that will roll over into most likely a Vanguard, because Facet is putting us in Vanguard.
Okay. Now, here's my next question for you. House. You own a house?
We do own a house.
How much is it worth?
It is worth conservatively about $550,000. We have a mortgage of left $78,000.
Wow, that's not a lot at all. How much? What's the interest rate on that?
2.99 from 2016.
Oh my God. Okay. We'll get back to Jennifer's question in just a second. If you've got a financial matter that needs a little, ironing out, or you've got a question that needs to be answered, just go to JillOnMoney.com, click the Contact Us button. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money, and we are here to try to guide you through your next best financial decision. If you've got a question that's on your mind, or maybe you need some help figuring out which is a better job offer for you, anything that's remotely financial, just go to the website JillOnMoney.com, click on the Contact Us button, and we'd be delighted to answer that question. While you're on that website, why don't you sign up for our free weekly newsletter? Every single Friday, Mark compiles a lot of really interesting stuff from around the World Wide Webs. and we'll bring that to you. So just sign up. Free weekly newsletter. Just get that at JillOnMoney.com. Okay, so now we are going back to listener Jennifer, who is on the line from New Jersey. You're talking about whether or not she needs a financial planner. So let's get back to Jennifer. And you got some cash floating around, emergency reserve?
Yeah, I'm a little conservative. I grew up poor, Jill. I like money. I like having lots of food in my house.
Yeah, so I like it.
My pantry looks like a Walmart, basically. My friends come over and shop.
She was like, you were basically prepared for the pandemic.
Yeah. I mean,
pandemic just caught up to you in terms of your hoarding.
That and the social distancing, because I'm pretty antisocial. But
already, I like you. Exactly. So what's in the emergency reserve?
The emergency fund right now is $115,000.
All right. That's good.
Okay.
That's great. Don't worry about it. That's fine.
But I do earn interest.
You do?
Yeah. I have an account with a bank, online bank called HM Bradley. That pays 3% up to $100,000.
Oh, that's great. Where'd you find that? We just do a little search, or did you go to deposit accounts?
I am online looking for that stuff. That is like my favorite thing to do.
Fantastic.
I am a bank hustler.
Oh, I love it. I love that. I really want to hire you. Are you sure you don't want to become a CFP yourself?
Well, I am a CFP for my friends, all of my girlfriends. I spend time looking at their benefits packages.
Oh, my God.
Because this is the thing. Black women act like money is somehow going to magically appear on a tree somewhere. And I'm like, no, if you don't own your money, you will be owned by money.
It's funny that you said Black women. I feel like it's a lot of women. It's
a lot
very
of women,
strange.
It is,
right?
But I can only speak to me, myself, and I. Yeah. And for me, I just feel like we have this fear of money, but it's really powerful because that fear owns you. And growing up without a lot of money, I said, what I'm always going to have, I'm going to get myself a position that I'm secure. Because then money won't own me. It'll just be a tool to do whatever the heck I want.
You have really, you've taken control of this.
Yes.
You've hired a company to do it for you.
Yes.
And so how are you feeling about that? Like, do you want to take this over eventually? Because there's no reason why. Yes. You sound incredibly bright. And, you may be the kind of person who can easily manage her own money and financial life. So how would you feel about that?
That is the plan. Really and truly, what I'm trying to come up with is a plan for now, because the plan in the future is pretty basic. We're going to work until we no longer enjoy it. And then the next step is going to most likely be immigrate to Portugal. We both love Portugal. My Portuguese is, but it's getting there. The weather really, and it's really for me. I have a lupus in my family, so I have chronic joint pain and arthritis. So cold weather is not my friend, which is ironic since I love the downhill ski, by the way. I'm always the only Black chick on the ski mountain. So, if you ever see a 6 foot tall Black chick skiing,
you're going to say, hey, hi, it's Jennifer. I'm here.
But it's fine because I'd rather ski and have pain for 2 or 3 days afterwards than be sloshing around New Jersey in this crappy weather.
How are you going to get to Portugal? Like, do you have a European passport, or are you just going to?
No, but the field that my husband is in is very desirable in that part of the world, and it's very transferable.
Okay, great. All right. So people who do it themselves, the do-it-yourselfers, there's sort of like this high bar that I put out there, meaning that you have to have the desire, which most people are like, I don't want to do this myself. Okay, so you have to have the desire, you have to have the time, you have to have the energy, and you have to have somewhat of the expertise. You don't have to be an expert. What you have to be is kind of like understand the general premise of financial planning, which is, okay, we're in our 40s, we're socking away a lot of money, we have a lot of money, everything's cool. What we're going to plan to do is continue to do that and, try to make this transition so that we can move overseas. And what's my time horizon to move overseas?
Well, really, when my doctor says we're going to medicate you because your pain is no longer manageable by exercise and diet and stress reduction. Okay. So, I've already, to put it in perspective, the joint pain, my sister has the same issue and she's had both hips replaced at 49.
No way. That's terrible. Holy crap.
Living at 46, but I do exercise every day. I am ridiculously, if you think I'm obsessed with money, you should see my diet. I do everything that I'm capable of, but of course, genetics is genetics.
Right.
So
I think that what you could potentially do in your new relationship with the planner is to say, I'd like, a game plan that in 5 years lays out how I would basically move abroad and let them do the work. Right.
Yes.
And say, presuming that, I'm just going to say this, like when I'm 50, 52, whatever I am, we want to move abroad. We're still going to be able to work, maybe not make quite as much for you, right? I don't know if you could or you couldn't. And I want to see what that looks like for retirement, because I get the sense you don't spend a ton of money, miss. I'm ready for Armageddon in her pantry. So, I mean, if you think about it, right now you've got 6, 8, $1 million, you got like $1.2 million already, not to mention you got a ton of equity in the house, which you could just blow out and use that money and spend it. And I think the only thing that I would consider doing, if that is really your game plan, is I really think beefing up the brokerage account is going to be important. You're going to have some non-retirement assets that are available. But I have a friend of mine who does planning work, and she is so excellent because what she'll do is she'll say, I can do the plan, you can execute the plan.
That's
and so you can have a plan that is conducted for you. You can do some, you can get out of this other environment. You want to get divorced. This is like your nice relationship. Your nice, it's not a rebound relationship. It's sort of like that nice, comfy relationship that may not be the long-term relationship, but it's kind of good right now. And I think that would be a good step for you guys. And then you can take it over. You really can. I don't want you to think that there's no mystery. And when I say take the mystery out of your financial life, you know what I'm usually saying? I'm saying you are the mystery. You put all that emotion into it. We all do this to ourselves. You sound just like the type of person who could do it yourself. You really do.
The last week's thing that just started, well, it will start in a couple of weeks, is that we now have a potential for the pension because the new job has a pension.
Oh, that's so great.
And healthcare from 59 and a half. And your dependents are covered. He's going to love it. I mean, it's just like...
He's going to love it because you're going to make him love it. Let's be honest.
Well, he's going to love it because it's right up his alley. He has this kind of mind that I can't even fathom, that actually likes math and science and putting stuff together and figuring out how things work.
I would tell you something. You're pretty mathy. I think you got
I'm only mathy if there's a dollar sign in front of it. I kid you not. That is the only math that I understand. If there's a dollar sign, yes. When you start getting into all the technical mumbo jumbo, I'm like, dude, my head hurts. Just stop.
My God. All right. So I think this is all great. It all makes, but again, it's also makes sense that you can now use this opportunity, use this new relationship, get the planning done. And, from there, you can decide whether or not you want to take it over. You can take your time doing that. It sounds like a great plan. If you, like Jennifer, need a little bit of guidance, we'd be happy to help you out. All you need to do, just hop on the website, jillonmoney.com, click the Contact Us button. Why don't you just bookmark that website while you're there? Then you can get all of the content that we create all week long. There's always something fresh and new. Okay, we'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money, the program that tries to take the mystery out of your financial life. We put out a ton of different kinds of media all the time. So if you want to catch up, maybe it would be helpful if you just bookmarked jillonmoney.com. I write new blog posts all the time. I usually am doing that because I have a column that is syndicated for Tribune, and maybe I need some help thinking through an issue that is going to help me on television. And if you want to check out my television appearances, we certainly have a video section. And maybe you'd like to find more of us, more of Jill and Mark and the audio stuff that we do. If so, check out our 2 podcasts. 2, not 1, but 2. It's Jill on Money and I on Money. You can get those both on our website. Okay, now let's go and do a little marital counseling. It's Angie and Gary from California. I love that we get these couples on. It's so good because if you want to like throw shade at your spouse and they're not on the line, that's not cool, but you can just do it together. So tell us what's on your mind. Welcome to the program. And I beg you, don't tell us how nice it is in California.
You got it.
So what's up? What's going on, guys?
So we are wondering if it's a good time, based on our age and where we are in life, to convert some of our IRA to Roth.
Tell us about yourselves. Like, how old are you?
I'm 57.
And I'm 56.
And we are both retired.
What? Wait a minute.
Yes.
How are you retired so quick, so early?
Just dumb luck, I guess. I don't know.
Wait a minute. Hold on. You're both retired and you're my age. It's daunting. What are you doing with yourselves?
Well, that's part of the issue, I guess. We do kind of temporary work and gig work. And then we love to travel. So that's all part of it. We are earning our pensions. We are collecting our pensions.
Okay, so tell me about the pensions. How much money's coming in right now?
So we have in our pensions together, we have $10,598 a month.
What?
That comes in.
Come on. What were you, like superintendents, both of you?
No. We're actually both retired from law enforcement.
Oh, I better be careful, Mark. I have a very hard time with authority. I'm going to tell you that right now. Okay.
Lock it up.
Okay. So you've got these pensions, which is great. Any other income besides that? You said temp and gig work. About how much from that stuff, like part-time stuff? What are you taking in about?
Well, probably about last year, we brought in about 100,000.
From both pensions and the part-time, or are you saying in addition to that?
In addition to the temporary and part-time was almost 100,000.
Holy crap.
We go out and we work at nuclear power plants when they do refueling.
I don't even know what that job is, but that's super scary. Whatever you just said sounded horrible to me.
It's actually not as bad as it sounds.
But
Really?
It's intense. It's short term, but it's 6 days a week, 12-hour days. And so it pays pretty well.
Are you going to continue doing that? That's like insanity, though.
Our local power plant will be shutting down in 2025. So there's that. But we have started doing that out of state as well. So we're not sure how much longer, maybe just until 2025. So.
But that's a lot of money. So let me ask you a question. Let's just go through some other stuff. You have pension income. You've got this part-time income. Do you guys have some savings, like an emergency reserve fund also?
Yeah, we have about 42,000 in our emergency. We have another 11,000. So we have a total of about 68,700 in real liquid type.
And then what about retirement accounts? Because you're in law enforcement, did you also use a deferred comp?
We did. And so we have now in our traditional IRAs together, we both have 271,400.
Okay.
And then we have Roths that are about 75,164.
When you talk about that pension income, does just the pension cover your needs?
Yes.
Okay. That's
More
what I
than,
thought.
yeah.
Do you guys have a cost of living adjustment with that or not?
We do, yes.
Okay. How about non-retirement money? Do you have like some brokerage account money or fund money account, anything like that?
Yeah, we just recently started an account and it's got about 15,500 in it.
How about the house? You own it?
We don't own a home currently, but we pay rent actually to my father-in-law, but we stand to inherit the property upon his passing.
Okay. How much do you pay in rent?
$1,000.
Stop it. No wonder you have so much money. So on the 100,000 that you earned, what did you do with that?
Well, last year we took a nice long 7-week RV vacation.
Which we
Nice.
purchased a motorhome
All right.
for.
All right. Oh, okay. That's cool. So you made a big purchase.
Yeah.
I think the idea of moving from a traditional to a Roth could make sense, but you're making a lot of money. So, you're in California, high tax state. You are married filing jointly. So you don't have a lot of deductions, right? Because you don't have a mortgage deduction, you don't have property taxes. So you're solidly in the 24% tax bracket. And there's not much we can do about that. I mean, let's just say that the money grows. Don't put more money into a traditional environment. That's for sure. If you wanted to, you could just build up that emergency reserve / brokerage fund, use that. And again, who knows what taxes are going to be. But if in 2025 and you've stopped actually doing this part-time work and your tax bracket goes down into 22% and you've got some money and you think it's time to convert, okay, maybe. I wouldn't do it right away. I really wouldn't. I like you having some liquidity. I think that there's nothing that's scary here. If we were talking about you were going to be on the hook for an enormous tax liability down the line, then maybe. But I don't think you will be. Frankly, even if you just had to take your required minimum distributions, so be it. Big deal, right? Like you could do it. It's fine. There's no issue around that. And I think you are in unbelievable shape. We'll get back to Angie and Gary in just a second. If you and your spouse need a little help, why not just give us a holler, JillOnMoney.com, and click the Contact Us button. We'll be right back.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
You're back. It's Jill on Money. And before we went to the break, we were talking to Angie and Gary from California. I love having both of the spouses or partners on the line because it gives us the opportunity to really hear what's going on. And sometimes from an email or a message, I can't really get into the nuance. But what you hear when we actually have you with us on the air is that we can go a little bit deeper. Sometimes I'm able to identify something. Maybe it's an emotional issue. Maybe something else is going on. Or maybe you've got some conflict and you need an impartial third party. Mark and I are very willing to play that role. We will be your marital therapist when it comes to money. Nothing else. Sorry, that's outside of our expertise. Okay, let's get back to Angie and Gary in California. Now, one question to you. When you inherit Dad's house, do you think you'll need to do some work on that house, or are you feeling like it's in the shape that you want it to be in?
Yeah, we'll probably, there'll be no mortgage on it. That's already been done. But we will need to probably do some upgrades on the house.
All right. So that's another reason that I'd love you to just build up some money. How about, you have any kids?
We have 4 boys.
What?
And we have, count them, 9
grandchildren.
Yeah, 9 grandchildren.
Do you help them out at all?
When we can.
Well, but they're all self-sufficient. Our 2 youngest are in the military. The 2 older ones, they're all very self-sufficient. They don't need our help.
No.
Okay. So it's like if you wanted to. Nothing.
Exactly.
And by the way, if all of a sudden you're building up all this cash and you do the house and you got extra money, you could throw some money at the grandkids and help with, college funding or whatever. But like you are in fantastic shape. I love it. I love the plan. Do you have an estate plan? Do you have wills and powers of attorney and what? You're nuclear. You're like freaking Homer Simpson without a will.
I believe it.
Are you kidding me?
Yeah.
No.
Come on.
I knew we'd get in trouble about that.
I am up in your cage about this, girlie, because this is crazy. First of all, you were in law enforcement. Thank God nothing bad happened. What can I do? What's the cherry on top? How can I reward you?
Make it easy.
How about go to Policy Genius? It's a sponsor of the show, so I get nothing from this, gang. I'm just telling you, they have a module. Go to policygenius.com, complete the forms, and do it. And pay like whatever, a couple $100. If you don't like the outcome, then at least you've like started the process and then you get a lawyer. But you can just do this, even if you just did it online. I would be so grateful before you go into the nuclear meltdown arena.
Okay.
Sounds good. Yeah.
Okay, let's do a question from one of you. This is from Chitra, who says, I've listened to your very helpful advice and guidance on the WTOP business reports for over 25 years. You know what, Chitra, God bless you, but I haven't been doing this for 25 years, but I love WTOP. That is the monster station in Washington, D.C. and all the surrounding areas. I would be extremely grateful, writes Chitra, for your valued advice on the following situation. Oh, this is terrible. I lost both of my beloved parents in October of 2020 within 14 days of each other, and these were due to health issues that were not COVID related. They were 93 and 98. They were married for 74 years. Oh my gosh. 6 kids, very close family. My parents named me as the personal representative in both of their wills, and the process has now been completed, and I'm ready to distribute to my siblings all of the balances of these accounts. Okay. My question is, should I put the this is for Chitra, not for the other sibs. Should I put the inheritance in a regular savings account after paying a few debts I have, or another savings account? The CPA who assisted with all the financial accounting around the documents, I guess this is with her folks, advised that since it's an inheritance from our late parents, it's not taxable income. This is true. If it's an inheritance, you probably just got the cash, so that's good. And the accountant says you can just keep it in your savings account. That's true. Chitra, however, also wants to help my only child, my son, to pay off his Perkins school loans and not necessarily pay off her car now. The car loan will finish in 3 years. Chitra says, I'll be 65 this November. When do I apply for Social Security? Isn't it at age 66? I'm so thankful. Look forward to your valued guidance, Jill. Okay. So, Chitra, here's the deal. You should definitely pay off your own debts first. Okay. And then what I'm also considering for you, I'm just going to put your kid aside for a moment. Okay. I really need to know a little bit more about what's going on in your life. If you have an emergency reserve fund, if you have, let's say, 6 months of your living expenses in the bank, maybe even a year, then okay, maybe it's okay to pay off this loan for your kid. But what are you doing for your own retirement benefit? You can apply for Social Security whenever your full retirement age pops up. It's usually now it's either 66 or 66 and change or 67. You can go to ssa.gov and check it out. But I really want to be clear that when people are in these situations, I would hope that you would really steady your own ship, meaning you would really steady your own financial life first before you start worrying about what happens with your kids. So I'd like to know more about what's going on for you. Do you have an emergency reserve fund? Do you have other investments? What is your game plan around retirement? And then together we can make a decision about whether or not it makes sense to help your son pay off that loan. So follow back up with us, Chitra. And if you've got a financial question, just go to jillonmoney.com, click the Contact Us button, and we'd be delighted to field your question. Don't forget to sign up for the free weekly newsletter. Okay, we'll be right back. You're back. It's Jill on Money. We are here to take the mystery out of your financial life. How do we do that? We ask you to send us your financial questions. All you need to do is go to jillonmoney.com and click the Contact Us button. So, okay, this is, let's get a quickie done. This is from Jason. What's your opinion on using an after-tax brokerage to house all emergency reserve fund money? We max out all qualified accounts, and we've got enough in the checking account to cover our monthly expenses with a little buffer. If we have enough in the brokerage account that even a 50% decline in the market leaves us with 3 to 6 months of expenses, can we just use that as our emergency reserve fund instead of having a crappy high-yield savings account? Yeah, sure. Why not? I mean, look, the emergency reserve fund, just in general, we say it should be safe money, meaning that you've got to be able to access this money when the blank hits the fan. And if you can do that and you've got plenty of money that's available, that's fine. Some people do like to use a checking and savings account because it maybe qualifies them for free checking or some other benefits. But, given that we're in such a low interest rate environment, even though the Fed is starting to raise interest rates overall, I totally understand. And frankly, if you are happy with where you are, I am not going to mess with that. I'm all about keeping things simple. Listen, of course, there are many money market accounts that are paying, just as rotten rates. But, as long as it's there, that's fine. The one thing I will caution people about is some people will say, well, what about just using my retirement account and the money market inside there? That I'm not as excited about because I think with the brokerage account, it's a taxable account. It's easy. I'd hate to create a tax problem or a tax liability in the midst of an emergency. So let's keep it simple. Brokerage account is fine. Money market is fine. Checking savings is fine. All right? Great. Okay. Now, during the break, while we get ready for our next hour, go to jillonmoney.com. All you need to do is bookmark that website. It has everything you need. All right? jillonmoney.com. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome back. It's Jill on Money, and it's hour number 2. And I know that you wait every single year for the highlight of tax season. What is the highlight of tax season, you ask? I'll tell you what it is. It is when Ed Slott, IRA expert, Roth IRA cheerleader, and CPA join the program. You may be familiar with Ed from appearances on our program, or maybe you catch him on your local public broadcasting system because he's got some really good TV specials. Mostly, we love to have him because he really is able to distill everything that we need to know about preparing our taxes. So, it is tax season, gang, so let's get going. Here is the beginning of your overall tax preparation boot camp with Ed Slott. As you look at, where we are with the IRS, okay, I feel like this agency just gets hammered. I read the Taxpayer Advocate National Report to Congress. This blew my mind, Ed. Since fiscal year 2010, the IRS has had budget cuts, which resulted in a 17% staff reduction. And they say that's amid a 19% increase in workload. No wonder you've got, 250 million telephone calls that weren't answered and that there are backlogs of, 6 million individual returns. I mean, essentially, if anything needs a human being at the IRS, you're kind of screwed right now. Is that right?
Right. And not only that, again, same kind of issue. I don't know what their workload is. Are people working from home and answering questions and, sort of just saying anything if you can even get them on the phone? And they are understaffed and overworked. There's no question about it. The service it's just not there, not because of them. They just don't have the manpower. Everything is e-file now, but I saw something in the paper, I think a week ago, they called paper returns. Certain returns you have to file by paper still. And they say paper returns are like kryptonite to the IRS because somebody actually has to look at them and make decisions. So if you submitted a paper return, for example, if somebody was deceased and you wanted to claim a refund, that has to go in by paper, or if there's been a death, sometimes that has to go in by paper or an amended return. Forget about those. Those will take forever. Make sure everything is correct from the get-go. It's so important because making corrections will require some kind of human element at the IRS, and that could take literally years.
Ed, I saw something come out from the IRS that said, even if we haven't processed last year, go ahead and file as you normally would this year. So what's the deal with that? Like, there are a bunch of people who have contacted us who said, I'm still waiting for my refund. What do they need to know?
Well, if you filed online like e-file, you would have got a confirmation that at least they received it, so you can count on that. I know we use a professional tax preparation program, so as soon as it goes through, we get the confirmation that it was accepted. So that's good. That shows it's there, so you don't have to worry about that. If you don't have that, then you have to wonder, but you have to go on the approach that they've got it. In other words, if there was a credit carryover, an overpayment, take credit for that. If you have a capital loss carryover, take credit as if it was accepted as filed.
That's interesting. The IRS also says that when you're e-filing for this year, that this is a little bit quirky, that you have to enter $0 for last year's AGI when you e-file this year if you haven't gotten your refund back. Like, essentially, that was a separate note. I thought that was kind of interesting. It's not intuitive to me. I would have just said whatever I put on my form for last year. But they're saying if you didn't get your refund and we didn't actually send you the processing, the return is all set, that you got to enter 0 for last year's AGI on your 2021 return.
Yeah, you know what? I might take the approach. Normally, for years, I used to make sure people withheld enough so they always were kind of overpaid, so they never had to worry about it if you're taking credit. Mm-hmm. But if you're counting on a refund, maybe now I'm starting to think it's better to owe money rather than sitting around and wait for a refund.
Yeah, no kidding. That's so true. All right. Can we talk about the child tax credit?
I was hoping you weren't going to say that. Because this is where you need to reconcile, and I'm not even that much of an expert on all this stuff, but I know the basic theory. You have to reconcile what you received to what you're entitled to last year, this year, because remember, people were front-loading payments, and there's this new letter coming out called Letter 6419, and you have to keep that letter to keep track of what you received or what they say you received and make sure it meets your records. And then you take credit because there's this reconciliation. It's the only word I can think of to describe what's going on, what you received, what you should have received. Maybe you're supposed to get more or take less. You have to have records. I hope people are keeping records on what they received. So when they get this letter should give a lot of that information because everybody's at a different status and different income.
Right, because the child tax credit was always in existence. We always had a child tax credit that was on the books. What we had after the stimulus plan was an enhanced child tax credit, whereby you got half of the credit last year in monthly installments. And not everybody did this because you could opt out also. And then the other half comes when you actually file your return. So you're right. I mean, I saved all these correspondence from the IRS, which is like, hey, keep an eye on your mailbox. I'm like, oh my God, that is so counterintuitive in the universe. But yes, okay, I'll do that. That letter has information about how you claim the rest of the money. But interesting, you also can go to the irs.gov website. I think the website is great. I really do.
Yeah. There's an actual portal. I was just looking it up it's called the Child Tax Credit Update Portal site.
Yep. And so you can go check that out. But the thing is, there's also this other weird category, Ed, because, okay, so the child tax credit is, based on the size of your family and also your income, right? So if you made less than $150,000 married filing jointly or 75 single, you are going to get the full credit. There are also people who maybe wouldn't normally need to file a return, and it seems like they're going to have to file a return to get the other half of their child tax credit money. So That's very confusing to me.
Yeah, and there are a lot of these agencies that it may pay to get a professional preparer to figure it all out, because there's a lot of numbers involved. Something that was supposed to help people with less resources now may cost them more to get that help.
Yeah, so not only did the IRS send you a love letter, 6419,
Right.
there's a separate letter, Ed, that they sent out. Good old letter 6475. I mean, it's music to your ears. Anyway, this is about your third stimulus check. Stimulus checks are not taxable. The reason is it the reason why you need this letter to find out whether you're actually entitled to the credit if you didn't receive it?
Yeah, well, they're not taxable. They're treated like you paid in tax. It's like an additional payment, like a rebate. So it adds to your refund or it takes away from any balance due. But your income can change. Maybe you thought you qualified, now you don't, or you didn't qualify and now you do. So that's why I say it comes back to you got to reconcile what you got, what you're entitled to. And hopefully this year it'll finally come out in the wash and there'll be the end of all this stimulus stuff. Not that that was bad, but reporting it. And remember, it wasn't just one stimulus they changed. It was 300, whatever the amounts were, then it was doubled, it was half. I mean, it was all over the place.
We'll get back to our interview with Ed in just a second. During the break, hop on to JillOnMoney.com and you can check out all the great info. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money, and we are in the midst of tax preparation season. And the last few years have been so strange when it comes to tax prep, between the deadlines being moved and new rules. Well, we know that you have big questions about taxes. So a couple of things to remember. Number one is we have a nice tax prep article on the website. Just some of the things you need to know for this particular tax season, which I know every tax season I say this, that it's difficult. This one really is. It's that child tax credit, lot going on. But also we have a host of other resources for you to check out on the website. So go to JillOnMoney.com and there you can just bookmark it. And of course, to honor the fact that we are in the middle of tax season, we have our guest, one of our favorites, I have to say, friend of the show, Ed Slott. Now, Ed is a CPA by training. He's also the expert on IRAs and Roth IRAs. And one of the reasons we love having Ed in our back pocket is we can call on Ed when we have a tough question from one of you guys. And Mark tells me all the time that he and Ed have a whole relationship that's going on behind my back. Yeah, I know. I'm used to it. It's okay. So if you've got a question and it's really maybe a detailed one, we may actually find Ed to be the resource we need. Right now, we are going back to our conversation with Ed Slott. And remember, his website is irahelp.com. Here is more of our conversation with Ed Slott. Last year, tax filing time, there was this little bit of relief for people who received unemployment. Now, I know the job market's hot again, but still a lot of people did receive unemployment benefits last year. When you get this form 1099-G that says, here's the unemployment, benefits that you received, does that form tell you whether or not you had taxes withheld?
Like a regular 1099, there's a box on there that says federal tax withheld.
Okay. So some people hopefully did withhold taxes just for the heck of it, right?
But some people never even received it because a lot of them were not sent out. Because some of the states are like saving money or whatever, and you would go to the website. We had to do that for a few people. You go to, in our case, New York State Tax Department and, put in your number and get your 1099-G. They weren't sent out in all cases.
Oh, gosh. So, Ed, let's now take a breath. We're going to go into your favorite topic of all time, Roth IRAs.
Oh, yeah, it is my favorite. I love tax-free. I love Roth IRAs.
You know that Mark channels you. When we're on the program, he'll say to people, for example, we had someone today, we were talking to somebody earlier today, single person, makes $350,000, lives in California, okay? 31 years old.
Yeah, okay.
35% tax bracket, lives in California, high tax state. So he's doing the first $20,500 as pre-tax, and the rest he's doing the mega backdoor Roth. So 2 questions for you. Number 1, what do you think of that? Mark Talercio wanted him to do all Roth, even if he was in the 35% tax bracket. What do you think?
I agree with Mark. You know why? I mean, and nobody likes to hear this because nobody likes to pay tax up front. But the deduction you get is not worth as much in the big picture. And you might say, but, the whole Roth scenario is one big giant bet on tax rates now versus the future. So some people say, but in the future, I'll be in a lower bracket. That almost never happens. If you're already in a top bracket, like this guy in his 30s, the odds are you're going to be in the top bracket for the rest of your life. That's a pretty good bet. So I would rather, bite the bullet now at today's rock bottom low rates, even at high rates. These high rates may still be the lowest rates you'll ever see. The fact that you took a 20,000 or so deduction, remember, that's just a timing difference. A deduction is like a debt. It means you owe that money back. Why take out a debt? Because that's what it is. Anytime you take a deduction for an IRA, there's payback. Your IRA, any deduction, your 401k, it's like a deal with the devil. At some point, it has to come out and you'll pay and then some, maybe at future higher rates. If they can get it all in as after-tax money, then it grows tax-free for the rest of your life.
It does not matter if he's in a high tax state like California or New York?
Well, I would look at everybody's situation, but I would always say, what do you think your tax rate is now compared to what it might be in the future? Some people might say, well, I'll be in a lower rate. I don't really think that's true. I don't see rates for high earners ever going down from where they are today. In fact, if they do nothing after 2025, under the law, the rates are scheduled to go higher.
Mm-hmm.
And somebody like this obviously has the money because they have the disposable income to put all that money in the mega backdoor Roth. But there's a second part to that question you didn't ask yet.
How safe is the mega backdoor Roth?
Right. I wouldn't do it now because it's on the chopping block. If this Build Back Better or whatever version of some future tax bill ever passes, this one's going along for the ride. This is not controversial. Nobody's talking about it. Last I looked, I didn't see anybody picketing outside the Capitol with signs, "Save the Backdoor Roth." There's not a big constituency for it. So,
and it is a giveaway to rich people, even though many of those rich people listen to this program. It is, right? I mean, we have to admit it.
So I wouldn't do it till we know it's doable. Because then you have to undo it. Now, I would feel like since they didn't, a lot of this was proposed in 2021 thinking it'd already be effective. And that provision was to knock out both the backdoor Roth and this mega backdoor Roth where you load up in your 401k, like Mark was talking about, or your example here with this guy. It's still in the bill. And if there's anything, that provision in the bill says they're out as of 2022. Now, would they change it now that 2022 is here? I might give it a month or two or so, see if anything passes because it's going to go along for the ride.
Mm-hmm.
It's not anything being debated, let's put it that way, in Congress.
Okay, but the mega backdoor Roth is different than the Roth. Do you think the Roth is at risk as well?
Both. The provision covers both. And that's regardless of income. That's one of those interesting provisions in this proposal. Again, this is not law. These are proposals. In the Build Back Better bill, this is a proposal to eliminate, to actually end backdoor Roths and mega backdoor Roths, regardless of income levels. So for everyone.
And so you would say, if you're the kind of person, for example, like Mark Talercio, executive producer and certified financial planner. Mark, when do you usually do your backdoor Roth?
Usually sometime in the first quarter.
I would hold off. Remember, we're talking about backdoor Roths pretty much. Well, you could still do technically for 2021, but still, it's because you still have till that April 18th date to contribute to Just for other listeners that don't know, the way the backdoor Roth works is a process. This is for people whose income is too high to contribute to a Roth IRA. So what they do is instead, they contribute to a non-deductible traditional IRA, which has no income limits, and then convert that to a Roth because there's no income limits on who can convert. So when you do the conversion under this proposal, even though the original contribution may have been for 21, the conversion will be a 2022 conversion, and that may be knocked out if anything gets passed.
Okay, let's just for the heck of it say, as you noted, it is possible that these plans do get knocked out. For people who have done them already, it's not going to be like, oh, you have to undo them. You just can't do it in the future, right?
I don't know. Right now, the way the wording is, it's out after 12/31/21. So it's already outlawed in the proposal. The only thing that would save that, based on what you're saying, the scenario you're saying, like it would be grandfathered if they change the effective date to the date of passage of the act.
Okay, I getcha. We'll get back to Ed in just a second. During the break, hop onto JillOnMoney.com, click the Contact Us button if you have a question that pertains to your taxes or anything else going on in your financial life. JillOnMoney.com, that is the key to getting all of your questions answered. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. Let's get back to our conversation with CPA Ed Slott. Do you think that there's a lot of money in Roth assets. So do you think that there is a world in which the Roth goes away?
No, I'll tell you, Congress loves Roth IRAs. They're addicted to the income it brings in.
Oh.
They will never tell you that because it's their golden goose. And why? Because they are the world's, Congress I'm talking about, they are the world's worst financial planners on earth. So why not take advantage of that? They only look at what they get up front. So they love Roth conversions. Every time for years since they eased up and allowed more people into the program, they saw boatloads, windfalls of tax revenue they use for all their other pet projects. So it's too good to be true. They won't kill their golden goose. Maybe they'll trim around the edges a little and say, well, if you take a distribution, these other things may be taxable or something like that. But they're not going to kill their golden goose. That's just my feeling. And they prove it over and over again. For example, in the Build Back Better bill, it's like the worst.
I know. I hate it. The BBB.
Yeah. There's a provision in there, separate from the provision I talked about, that for high income earners, they would ban Roth conversions outright. That's that provision if your income is over $400,000 single or $450,000 married joint. There would be a outright ban on Roth conversions. The other part I talked about, the backdoor Roth, that's after tax. This is all Roth conversions. So now they're saying that they don't believe that high-income earners should be able to do these big Roth conversions. So they put this complete ban in the Build Back Better bill. And the interesting part is, which shows the secret I just gave you, that one provision, the effective date was 10 years out, for years after 2031. So on the one hand, Congress says we don't want these people converting with all their, high income, but we do like the income it brings in. So we're going to let that continue for 10 years because we love the revenue we get. It fits perfectly in our 10-year budget cycles. So they want the money. So all they're doing with a provision like that is accelerating the very behavior they're saying they don't want because they want the money.
Yeah, of course. It's so funny. They're so full of it. It's hysterical. You're right. They're just terrible managers. Mark, what other questions you have?
Ed, if people lose the ability to do Roth conversions, or the backdoor Roth, I should say, if they lose that ability, they obviously make too much money to do a regular Roth. is there any benefit to doing a traditional? Doesn't it just make more sense to put the money into a brokerage account?
I think so too, because again, well, you could do a non-deductible IRA, but then you have people like that. They sounds good until they have to do the bookkeeping on it, so to speak, and keep track of what percentage of your IRA is non-deductible, what's deductible. You have to file that Form 8606 and report that every year. It's just you have to keep track of things, and it gets to be a pain in the neck for some people, and some tax professionals miss it altogether. I think you're better off, as long as you're doing that, put it into a regular like brokerage account and get the benefit of lower capital gain rates.
What do you think is the possibility? In Build Back Better, there was no conversation that seemed to be like people really pushing back on changing capital gains rates. What do you think the reality is on that front?
That's more likely. I thought you were going to go to the third rail and say, are they going to touch step up in basis? And the answer to that is no. It never worked. Last year marked the 100th year, 100 years of step up in basis. And every time, if you look at the history over those 100 years that it came up, whenever there was income inequality and all of that stuff, they said, let's get these people and stop step up in basis. And every time they try to do it, it failed, because in the end, it fell mostly on the unintended targets, people that were like a 1-year millionaire. They had a sale of a house that went up in value. That's happening a lot now, or a sale of a business, and they got caught up in that. But there was a time in the 80s, if you remember, where the capital gain rates were the same as ordinary income rates and everything was fine. Do you remember that?
Yeah, of course. You know my feeling on this. I know you hate this because this is really just me saying like fairness. Even though I profit from a capital gains rate being at these low levels, it's insanity to me. It's insanity because it would not make a hill of beans of difference if you had, no one would say like, oh, I'm not going to invest anymore because I have to pay, ordinary income on my gains. That's baloney. Everyone would invest. Maybe they wouldn't trade as much, which I think would be great. Fine. Or make it a 5-year hold period to get the good capital gains rates or something like good like that. I also think, by the way, the idea of excluding gains on housing is ridiculous. Completely ridiculous. I can't imagine how many more benefits the government has to give out to people who buy versus rent. It seems ludicrous to me.
Well, the only thing with houses is, I'll give you an example. Years ago, my father died many years ago, but after that, my mother sold the house and we grew up in, and it's the same little house. He bought it for $16,000 and she sold it for $500,000. But that's what that house was worth then. I can't believe it. Mm-hmm. So a lot of that was just inflation. There was no real gains in there.
Yeah, but that's the same with stocks. You would then have to apply that exact same thing. Oh, my mother worked at American Express and she bought shares for, pennies and now it's worth so much more. Well, a lot of stock increases has to do with inflation also. We make such a strange distinction on this.
Right, that's true.
The tax code could be way simpler if you just took away all this crap and just said, okay, everyone's going to pay tax whether you earn the dollar or whether you earn the dollar on an investment or a house. Like, it would be a much fairer tax system. I've had this rant for many years, so I'll just stop now. What else, Mark, do we need to know about the brain of Ed Slott and how we can make ourselves seem really smart right now?
You don't see him, Joe, but we get a ton of questions from people asking about the back door. So how long do you suggest that they wait, Ed?
Oh, you don't have to wait at all.
No, I mean before we see if Build Back Better becomes a bill.
Oh, I thought you meant the actual process. I don't know. Every day I look at Congress and it's in, it's out. I'm just saying if anything passes, that's going to come, that's on the train already.
Yeah. It's certainly, I think, worth waiting first few months of the year. I mean, Mark, what about if our general advice is like, let's check in on whether or not to do your backdoor Roth at the end of the first quarter. Let's see where we are. If it's like, hey, Joe Manchin has killed Build Back Better, there will be no part of it that passes, fine. Then you can go ahead and do it. But we'll know more information. Even if it's not clear, it's like I know whether or not to try to pull the trigger or not. Well, thanks again to Ed Slott. He's such a great resource. If you've got a question for us or Ed, just go to JillOnMoney.com, click Contact Us. We'll be right back.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
You're back. It's the Jill on Money Show. We are trying to take the mystery out of your financial life, one question at a time. And for that, it means that we rely on you to ask us those questions. That means you got to do something. Here's what you got to do. Go to JillOnMoney.com, click the Contact Us button, and we'll get your note. That's it. That's how hard it is. Just one little click away, a couple clicks, I guess, if you're, counting. Anyway, let's get some of these messages back to you. Glenda is 60. She says, I own my own house and I work full time. I'd like to sell the house and will hopefully keep working for 10 more years. Good one. I like that. A little longevity here. Glenda says, I make $70,000 a year, but I'm unsure as to how to invest my money. I will get from the sale of the house about $400,000. She says, I've got no retirement and about $60,000 in savings. Now, this is the money that I need to last for the rest of my life. Oh, my gosh. I live with my daughter in a mother-in-law basement in their house, and I pay them $1,000 a month for rent. Please help me with a retirement plan or just an idea of where to put my money. All right. Well, listen, Glenda, I think that there's a couple of things I need to understand. Number one is you're going to make this $70,000 a year. Now, without the house, you should start to save some real money. Do you have a retirement plan available to you? That's number one. When you reach age 70, what will your Social Security benefit be? That's number two. Number three is how much do you think you need beyond the $1,000 a month for rent? What are your other expenses? And then we can try to determine the best way to take that $400,000 and put it to work for you. Ideally, I think if you tally up all of your expenses, because you're going to have to do that for my retirement planning homework for you. If you said to me, for example, like, I need $3,000 a month or $4,000 a month, then, what I would think is that you've got enough money in savings. If you have no other debt that's outstanding, you've got the savings, then the $400,000 has to be very conservatively invested. And I certainly wouldn't go more than, 50% in risky stuff and 50% in less risky stuff. But I also feel very sure that because you say you don't know how to invest your money and you don't really have investments, that maybe you could be the type of person who could benefit from working with a certified financial planner. Maybe you actually want to pay somebody to do this because doing it yourself seems a little scary. So, Glenda, what I'd like to know is the answer to some of those questions. And then let's find out if we can help get you in the right hands. So the right kind of organization for you. So follow up with us. Let us know. Okay, this is from Sam, who's got retirement plans, IRAs, 401ks, and they're held with Fidelity, Schwab, TD Ameritrade. And Sam also says that he has noticed that there's a big investment firm in his area that's advertising that they're fiduciaries, unlike other money managers. And then he says, I noticed that you did not list this firm in your article that was recently published in the San Jose Mercury News. I mean, I guess that I usually don't mention specific firms. I mention things, big, huge companies like Vanguard or Fidelity when they have a component with advice. Generally speaking, there's a zillion different firms that are fiduciaries. You should talk to them and you should try to figure out whether they have a program and a company that matches your needs. And what you may want to do is head over to the website, JillOnMoney.com, and you click on the resources section, and we have questions that you should ask before you hire a financial professional. Okay. And this is a follow-up because Barbara wrote about the article that mentioned Vanguard and E-Trade for inexpensive index funds. And she asks, is there a place where it can conduct research about these funds versus American funds or any other fund? I'm being told American funds have lower costs as well. I've never seen it recommended in articles I've read. Oh, that's because American funds have a load, Barbara. They're sold through a broker or an advisor, and you pay a commission. Once you own an American fund, which, again, you're paying somebody a fee for that, then they are pretty affordable. But to buy them, just in general, they're not no-load funds. They are not just cheap funds that you can buy yourself. You have to go through somebody, and that means that there's extra costs involved. And Barbara finishes up and she wants to know, is there a difference between a rollover or a direct transfer when moving from a 401k to an IRA? It's pretty much the same thing. So I hope that helps you out, Barbara. Okay. Let's see. Can I squeeze this in? Bill says he's got a high yield savings account at American Express at 0.5%. That's pretty good. He says, my friend has an annuity account. She says it's 2.8% for 5 years. Is that 2.8% a year or for the total 5? Okay. Here's the deal. She has an annuity which probably gives her 2.8% annually, but her money is tied up. So, she will have more money in 5 years, is presuming that's what you want to do with your money, which is just keep it in cash. If you want to invest it, the better comparison for the 5-year period would be, what could you invest in for the next 5 years? Remember, that money's going to be tied up for 5 years so that you could earn something comparable to that rate. And that would probably be a mix of stocks, bonds, cash. It's not exactly the same conversation, but it's pretty close. Okay, this is Jill on Money. Oh, I'm running so late. Let's go quick to the break and we'll be right back. You're back. It is Jill on Money, and we are here to take the mystery out of your financial life. And before we finish for the day, let's answer one of your questions. Remember, if you've got a question for us, just go to the website, jillonmoney.com, and click on the Contact Us button. It's just that easy. This is a question from Bill, who said he started buying stocks around 2008. Wow, already a long time, right? And he bought Sirius and a bunch of other stocks, and he's done really well. He says, I'll be 70 years old on my next birthday. Is it time to sell? I've got plenty of income from our pension. Should I take the money and run? Thanks. I hate to weigh in on individual stocks. I don't really know what else is in your portfolio, but, given that the capital gains rate is still very affordable, I think it might be worth at least looking at your overall portfolio and reallocating and sure, take some gains. Why not? And if you don't need the money, maybe something to consider is to gift some of these shares if you're charitably inclined, or even just give them to your kids. It's up to you. But I do think that having lots of gains in individual stocks is a good problem to have. I would want to know a little bit more about you. And again, if you think that because of your income and maybe you're in the 15% capital gains rate, it could be a great time to do this. And so, yeah, why not? Go for it. I say take some money off the table. I'm never a fan of letting it sit out there, especially if there's lots of risk. Okay, well, that's it. That is the program for today. Thank you so much for listening. We always encourage you to go to our website, jillonmoney.com, and click the Contact Us button if you've got a question. And we would like to remind you some of the business here. Our music is composed by Joel Goodman. Mark Talercio is our executive producer extraordinaire. We do encourage you to lift someone up today, because when you do that, you'll make that person feel better and you will make you feel better. Thank you for listening, and we'll talk to you next week.